If you are a freelancer and you think having 6 months of expenses saved means you are financially safe, I have some hard news for you. That feeling of safety you get from seeing 6 months of expenses in your banking app? For a freelancer, that feeling is a dangerous illusion. It's a security blanket that might just disappear when you need it most. Most financial advice out there is built for people with steady, predictable W-2 paychecks. It assumes a routine, reliable flow of cash. But our world is different. And if you are using the standard rulebook that tells you 6 months is enough, you are not just missing out on growth, you are actively leaving yourself vulnerable to the unique volatility of being your own boss. By the end of this video, I am going to show you exactly why that traditional advice is broken, and more importantly, how to build a number that actually lets you sleep at night without that lingering knot of anxiety in your stomach. But before we dive into the math, I want to address the elephant in the room: fear. We all know that feeling. It's that low-level hum of dread that sits in the background of your workday. You're working hard, you're landing clients, but you're constantly checking your bank account like it's a scoreboard that's about to reset to zero. This isn't just about money, it's about the erosion of your confidence. When your foundation is built on traditional advice that doesn't actually fit your life, you are setting yourself up to feel like you're failing even when you're doing everything right. Let's start by unpacking why the standard rule collapses the moment it hits the freelance world. The traditional advice assumes a paycheck hits on the 1st and the 15th. You know that. I know that. But as freelancers, we live in a completely different reality. We have a fluctuating invoice schedule that rarely aligns with our actual living expenses. Think about the unpredictability of a single project. You might have a massive month where you land 3 major contracts and you feel like a financial genius. You're ready to celebrate, maybe upgrade your gear or take that trip. But then the next month hits, and it's total silence. The phone stops ringing, the emails are sparse. This feast or famine cycle is the fundamental nature of our business, and it is the first thing that makes standard financial advice completely obsolete. Imagine you do a project in January, you invoice in February, you finally get paid in March. That right there is a 60-day gap. Now, what happens if that client pushes payment to April? That simple scenario is why your 6 months of expenses doesn't account for the reality that your cash flow is completely disconnected from your labor. This is the first thing that makes your emergency fund leak. You might have a high accounts receivable balance showing on your dashboard, and it makes you feel accomplished. But until that cash actually hits your checking account, it does not exist. Your emergency fund needs to be built on actual hard cash, not expected cash. Think about the psychological toll of this gap. When you work a W-2 job, you know the money is coming. When you are a freelancer, your brain is always calculating in the background. Did I invoice enough this month? Did that check clear? Can I afford this utility bill if the next payment is late? When your emergency fund is built on expected cash, you are living on a knife edge. You are one bad client or one slow payment cycle away from a panic attack. And that constant low-level stress, it ruins your creativity, it ruins your productivity, and eventually it ruins your business. We have to move past the idea that working harder is the solution to financial stability. The solution is building a system that absorbs the volatility so you don't have to. This brings us to the biggest mistake I see, and it destroys more freelance businesses than a bad client ever could. We commingle our operating cash, our savings, and our quarterly tax set-aside. We look at our total balance and we just feel rich. It's a trap. It's easy to understand why we do this. It feels simple. You have one account, you see one balance, and it's mentally easier than managing 4 or 5 different buckets. But that convenience is the cost of your future stability. If you have $20,000 in your bank account, and $10,000 of that is owed to the IRS in 2 months, you do not have $20,000. You have $10,000. Treating that tax money as part of your emergency fund is a death trap. I have been there myself. I once saw a big balance, thought I was flush, and then realized I had forgotten to set aside for quarterly taxes. It is a sinking feeling, the kind that wakes you up at 3 in the morning. It is not your money. It is the government's money, and you are just holding it. When you confuse that with your emergency fund, you are walking on thin ice and you don't even realize it until it cracks. And let's be honest about the tax trap. It's not just the IRS. It's the late fees. It's the interest. It's the sheer panic of having to find that money under pressure. When you commingle, you are essentially borrowing from your future self to fund your present comfort, and that is a debt that always comes due with interest. So, how do we ignore the noise? Stop looking at what your bank app says as your total worth. We need to calculate your true emergency fund using only 3 specific non-negotiable buckets. First, liquid. Can you access it in 24 hours? If it is in a 30-day CD or an investment account or locked in a business asset, it is not an emergency fund. An emergency doesn't wait for a clearing period. It doesn't wait for the market to rebound. It happens now and you need money now. Second, uncommitted. You must subtract all tax set-asides and upcoming business expenses. Look at your quarterly tax burden, your software subscriptions, your insurance premiums. If you have $10,000 in the bank but $2,000 is spoken for in taxes and recurring business costs, that money is effectively gone. It's spoken for. It doesn't belong in your safety calculation. Third, yours. Subtract any debt interest or payments that must be made even if your income hits zero. If you have a credit card minimum that must be paid to keep your business running, that is a commitment. Now, this might feel like you're losing money on paper, but you're actually gaining clarity. By stripping away everything that isn't truly yours, you are building a safety net that is actually safe. That final number, that is your real emergency fund. It might be smaller than your 6-month goal, but it is bulletproof. It is the only money you can truly rely on. And here is the journey you need to embrace. It is not about reaching an arbitrary 6-month figure. It is about reaching a number that reflects your actual real-world business risks. Imagine 2 freelancers. Freelancer A has $50,000 in the bank, but $45,000 of it is tax money and pending invoices that haven't cleared yet. Freelancer B has $15,000 in the bank, but every cent of it is liquid, uncommitted cash. Freelancer A is broke, Freelancer B is resilient, Freelancer A is 1 bad month away from disaster, Freelancer B is ready for anything. Which one do you want to be? This contrast is the difference between playing business and owning a business. Freelancer A is playing with fire, relying on the hope that the invoices will clear before the tax bill arrives. Freelancer B is playing with strategy, knowing exactly what is available and what is already spoken for. When you build your fund this way, you stop reacting to market dips. You stop making bad decisions out of fear. You won't take on low-paying, soul-crushing clients just because you are scared of a dry spell. You will have the space to pivot. You are not just saving for an emergency. You are buying yourself the freedom to say no to bad business. You are buying the ability to negotiate from a position of strength, not desperation. That is the true value of a real emergency fund. It is not just about survival, it is about autonomy. Think about the projects you could have turned down if you had this safety net. Think about the pricing power you'd have if you knew that if a client walked, you wouldn't miss a rent payment. That isn't just financial safety, it is a total shift in your professional identity. This mindset shift is about building true financial resilience. It is about acknowledging the reality of your business, not pretending you work a job that you don't. It is about clarity. Once you have this number, this liquid, uncommitted, truly yours number, everything changes. Your marketing changes, your pricing changes, your interactions with clients change. You stop being a freelancer who is desperate for the next win, and you start being a business owner who is building for the long haul. You might find that getting to this number is a process. It takes time. You might need to change your spending, you might need to adjust your rates, or you might need to be more aggressive with your debt repayment. But having that target, the real target, not the fake one, is the first step toward getting there. It takes courage to look at the real numbers, especially when they are smaller than you wanted them to be. But there is a profound sense of peace that comes from knowing exactly where you stand. When you stop counting tax money and imaginary future checks, You finally see your business for what it is, and you can start to grow it sustainably. So, take the time today, look at your accounts, separate the tax money, account for the debt, find the true number, and know that while it might feel smaller today, it is the strongest financial foundation you will ever build for yourself. If you are tired of the generic financial advice that doesn't fit your life, and you want to build a truly resilient, grown-up freelance business, subscribe for more breakdowns just like this one. And if you have already figured out a better way to manage your cash flow, I want to hear about it. Drop a comment below. Let's get to work.